Hello everyone, welcome to my YouTube channel. In today's video, we're going to be taking our time to talk about the market structure. As you know, the price of the forex market is always moving. Is it moving either from point A to point B, from a support to a resistance, from a demand level to a supply level, from a zone to another zone as you will have it. And we also know that the forex market have three major movements. You see that it's going up or it's coming down or it's moving sideways, guys. You see that it's going up or it's coming down or it's moving sideways, guys. As simple as that. But how does the market move from point A to point B? The forex market does this movement in structures. The market doesn't just move in a straight line. Now, for a market that is moving up, for an uptrend or for an upward moving market, in another word, the market is always making a higher highs and a higher low, a higher high and a higher low, a higher high and a higher low, where the market put up a high that is higher than the previous high or put up a low that is higher than the previous low. This is what I'm talking about, guys. This is just a simple illustration. The market makes a high, then makes a low in form of retracement, then makes another high which is higher than the previous high. This now become the current higher highs. This now become the current higher low. So the market also makes another higher low, then makes another higher high. So hence we say in the forex market, for an uptrend, the price is always making higher highs and higher lows, higher highs and higher lows. While for a downward moving market, or for a downtrend, the price is always making a lower low and a lower high, a lower low and a lower high, where the market makes a low that is lower than the previous low and makes a high that is lower than the previous high. Let me just give you an illustration. This is what we're talking about, guys. The market makes a low, then makes another a high in form of retracement, then makes a lower low, then makes a lower high, then makes a lower low. As simple as this, guys. The market makes a low, then makes another low which is lower than the previous low, or the market makes a lower low, put up a lower high, makes a lower low, put up a lower high, makes a lower low, put up a lower high. Hence the market keep going down like this until the market comes back to break, to make a low. It makes a high that is higher than this high. Hence we say that the market has put up a higher high, simply because it's higher than this high. And from here onward, you say that the structure of the market has been broken, has been violated, has been broken. Then from here, what you're expecting the market to do is to put up a low which is not lower than this low for it to continue upward. Let it come and make another high. I hope you understand that, guys. Let me just illustrate it again. Let me just do another illustration. What I'm simply saying is that what I'm simply talking about is that for an upward moving market, or a market that is going up, for example, what we expect the market to do is to put up a high, then makes a retracement or a consolidation, a low that is not lower than this previous low, but yet makes another high. Sorry, guys. But yet makes another high that is higher than this previous high. Hence, we say that the market has put up a higher high. Then makes another low, which is not lower than this, low, but can also be equal to this low. From here, we can see the market makes another high. From here, you can either say the market has made a double bottom or makes an equal low, but it's still an uptrend because it has not violated this previous low that was made. The market has not violated it. So what we expect the market to do now is also to make a retracement, makes a low, then makes another higher. Now also the same goes for a downward moving market. Like I've explained before, what you expect the market to do is for a downward moving market, you expect the market to make a low, then makes a high that is lower than the previous high, then makes another low that is lower than this previous low, then comes back to make a high that is lower than this previous high, then makes another lower low. Then what we expect the market to do is to keep going down like this. But mind you, the market can come back and make an equal low, like I explained here for the upward moving market. The market can also do it here for a downward moving market. And from there, put up another low, put up another lower low. But as long as this previous high wasn't violated, wasn't broken, the market is still very much in the downtrend, and you want to only be looking for sales in this market. Guys, you only want to be looking for sales in this market. The structure only changes when the market comes back to take out this high. When the market comes back to close above this last high, that's when you can say that the structure of the market has been broken. Then you now have to wait for confirmation to be sure that the market wants to start going up, because the market can break above the structure and enter into a major range or a major consolidation. But after breaking above this structure, like I taught in my support and resistance video, when a support is broken or a resistance is broken, they either both start acting as a support or as a resistance. In this case, when this resistance is broken, it starts acting as a support. So we can see the market come down to retest this resistance that was broken, that is now support, before it start going up, making a new high. From this point onward to this point, we can say that the market is in transition. We can say that from this point to this point, we can say that the market is in transition after it has broken this high. In the sense that the market, there's potential for the market to change into a bullish market or an uptrend from this moment on. Understand this, guys. The structure of the market only changes when price breaks a major support or resistance, or a major high or a major low. Like for example, the structure of this market, as I was explaining before, will only change from an uptrend to a downtrend when the market comes and violates this last high. When it breaks it down, like I said, the market is in transition, changing from this upward trend to a downward trend when it makes this retest before it starts going down. Mind you, though this is support that has been broken, the market may not necessarily come and retest this support from here before going down. Some market do, but some don't. So what you are expecting is sometimes the market can come as far as the 50% retracement for those that use FIB, or it can come as far as retesting an order block for those that trade order block before you can see the market continuing downward. So in this case, but as long as this structure has been violated, you are sure that there is potential of this market turning to a downtrend. There's potential for this market turning to a downtrend. I hope you understand this, guys. Now let's take some example before we go into the live chart. Now, simply like what I've explained before, when the market is going down, the market is making lower lows and lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Also, for an upward moving market, the market is making a higher high and a higher low, a higher high and a higher low, putting up a low, making a high that is higher than the previous high, and making a low that is higher than the previous low. So also for the downward trend, making a low that is lower than the previous low, then making a high that is lower than the previous high. Now, one thing I've not really talked about is the sideways moving market. Now, for a sideways moving market, we know that the market can move, can be in an uptrend, for example, can be in a strong uptrend. Then the market can get to a zone or a region where uh, there is it hits a region where there is high, for example, a market that is moving up, then hit a region where there is high number of people that are willing to sell the market. When the market is being pushed down and it gets to also a region where there's also large amount of buyers, what you see is the market will bouncing within that certain zone. The market will be bouncing within that certain zone until it breaks out, either to the upside or to the downside. We can see it breaks down or we can see it breaks up. But one thing I've come to understand, and with my experience and my backtesting, one thing I've noticed is that sometimes it's very easy to predict that the market will break to the upside depending on the kind of price action you get. While sometimes it's very easy to predict that the market will break to the downside depending on the price action you get also. So the market can come to this point, the market can get to this zone, then because they know that there's liquidity resting above this double top here and this triple bottom here, what the market makers may do is that they will run out liquidity at this point, take out liquidity if they are going to go down before going down, or what they will do is that for it, if they are intending to go up, because they know that there are a lot of people buying at this zone, what they will do is that they will take out liquidity here before they continue pushing the market upward. In some case they can in some case they can run liquidity in both sides, in some case they may not. See, one thing about the forex market is that although the structure of the market in terms of how the market move from point A to point B, higher highs and higher lows, is fixed, like it will always make higher highs and higher lows. uh, or and also for a downward moving market it will always make lower lows and lower high, but the way it does it might differ. It may not be the same for every time the market is trending, will not always be the same. Now, in this diagram, what you can see in this diagram is that when the market got to a particular point, it ranges, it moves sideways for some time. This is a weekly chart. As you can see here, this is a weekly chart. The market is making lower lows and lower high, but it does not do it instantly. It takes a time. So what the market does is that when it gets to its zone where you want to turn from, it may not just turn from them instantly. It will take some time to range in that zone before it continue going down. Also, what it did here also, but as you can see here, the market didn't take much time to fall. One thing you should understand is that the structure remains the same, but the way the market does it might differ for from time to time. While for the sideways moving market, you can either say that price is making equal highs or equal low, or price is bouncing within a certain support or a resistance zone. Now, the next thing we're going to be talking about is structural mapping, how you map your high and how you map your low, how you map your structural break. When exactly do you say that the structure is broken? Because sometimes, like I told you earlier, when the market breaks a high or breaks a low, you expect the market to change in that particular direction. In the forex market, some people use weak rejection. Some people use the body close of the candle to mark their high or to mark their lows. This might be the week of the market. This might be the week of the market, and this might be the body close of the market. Simply, we're going to go to a live chart. I just want to make an illustration here, but follow me, guys. See, this might be the week of the market, the week of the candle, the last candle that closed below the low, that made the low, or this might be the body close. Let me use this for example. Okay, it's a good example. This is a good example, guys. Just one more minute. Okay. Thank you. So some people might use the wick here to mark their structural low, or some people might use the body to mark their structural low. It depends, guys. But for me, I prefer to use the wick of the candle to mark my structural low rather than the body. Because one thing I've noticed that uh, when it comes to structural break, the market can close below the body, but yet still bounce back and start going up. But I'm more confident when the market in taking a trade in the opposite direction, or for an entry, or as to consider it a structural break when the market close, when there is body close below, a strong body close below the wick of the candle, below the wick of the candle. There I know I'm more confident to tell you that the structure has been broken. So let's take a deeper look into it. Now, these are the two illustrations I have here. The two illustrations I just gave just now is that first of all, we're going to be looking at the body close. Now, the body close mapping as structure high and body close above as structural break. Simply what it means is that the body of the candle, you can use the body of the candle close as your to map as your structural high, in the sense that when market come and close above the body of the candle, even without closing above the wick of the candle, you can say that the structure has been broken. You can use it to map your high, you can use it to map your low, depending on the one you are comfortable with. Also, we also have the wick of the candle mapping as structural high and body close above as structural break. Simply what it means is that we map out the wick as a structural high only when price come and close above the high, the body close above the high. That is when we say that the structure has broken.